This is Financially Fit Radio with Cory Sickles from Safe Harbor Retirement Group. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Cory provides his clients and prospects with the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful solutions to put you on the path to achieving your retirement goals. And now, here is Financially Fit Radio with Cory Sickles.
Welcome back to another episode of Financially Fit Radio. I'm Cory Sickles with Safe Harbor Retirement Group and Wealth Advisors. If you'd like any information or additional information from today's show, feel free to give us a call at 614-760-0670, or you can always visit us online at safeharboroh.com. And while you're on our website, feel free to click on that radio page. You can check out some previous shows, as well as subscribe to our podcast on Apple Podcast, Amazon Music, Google Podcast, or Spotify. Also, feel free to watch today's show on our YouTube channel. Just type in Safe Harbor Retirement Group. You can watch today's show as well as previous shows starting back here January of this year. Also, feel free to subscribe to our YouTube channel. You can keep up to date with our video shorts. We're putting about 3 or 4 videos out a week about different types of financial topics as well. Again, you know, our goal is to help you to make sure that you have the best retirement that you possibly can. So I highly recommend that you give us a call and schedule a complimentary, no obligation meeting with us. You know, again, we're here to help and guide you to make sure you have the retirement that you want. Well, today we're going to talk about, I think, something that's in the news every day, or it's been in the news every day for a while, and that's interest rates. How does lowering interest rates affect you, the consumer, kind of going forward? We'll kind of talk about that. It's a topic that everyone's really been talking about. How's it going to affect the market? How's it going to affect the economy? How's it going to affect money in your wallet as well? But before we dive into that, let me introduce to you my co-host this week and every week, and that's Tony Shore. Tony, how are you?
I'm doing great, Cory. Thanks for having me on the show. This is awesome. A great topic. We've heard so much lately about interest rates and the Fed and the economy. Of course, it's an election year, so everybody's talking about the economy and consumers and stock markets. So this is going to be a good discussion today. But I've been great, Cory. I've been doing really good, getting a lot done. Trying to get everything I can done this fall before winter sets in, which, here in Minnesota, it sets in pretty quick.
It starts in October, I think, doesn't it?
Yes, exactly. So, and that's where we're at. But Cory, I've been great. How about you? What have you been up to?
I've been doing good. Golf's winding down, Tony. That means football season's, full. I know your Vikings are off to a hot start. It seems like you guys do good when you have a no-name quarterback.
Isn't it crazy? And people, that's what they were saying too during the game, and the announcers even mentioned that. And locally, the sports talk guys are like, this is weird. If you look at the stats, like the years we've went the furthest, it's like, it's not a, what's the word? It's not a set quarterback like that we've been with for years. It's like we get somebody in.
Well, Keenum was your last one. He took to the NFC Championship game.
Yep.
Cousins couldn't do it.
Nope.
Maybe Sam Darnold's the guy.
Yeah.
It does help in your case to be able to throw it to Justin Jefferson a little bit.
Well, yeah. You got JJ, I think the number one wide receiver in the league on the team. But you know what it comes down to, Cory? I think the difference is the O-line too. If the O-line and the quarterback and the coach are on the same page, I think the offensive line, that's the key. And maybe the O-line and Cousins weren't on the same page. We've made a few adjustments to the O-line. I just think we've got a good combo. And Sam Darnold, nobody thought he would do anything, and we thought this would be a crap year. And they're just shocking everybody. And his numbers are great. I mean, he looks fantastic.
Yeah.
So I'm loving the Vikings and Ohio State, of course.
Buckeyes are rolling.
Yep.
Cleveland and the Bengals are off to their solid starts as normal. So
we don't have to mention the Ohio pro teams.
The Reds fired their coach. Indians are in the playoffs, so
Oh, Indians are doing great. In fact, they've destroyed the Twins. So yeah,
Yeah.
yeah,
So I'll be up in your
exactly.
neck of the woods later this week.
Yeah,
Coming up there for a conference up there in Minneapolis. So looking forward to seeing a lot of the Gradient folks as well as some other advisors that I'm good friends with as well. So it's a good
yeah,
time to be able to collaborate, learn some things, and
yeah,
um, yeah. I'm looking forward to that. So
yeah. That'll be great. Now the Fed. Were you surprised? Talking about interest rates, we can jump in. I wanted to ask you, Cory. Were you surprised that the Fed announced recently they lowered interest rates by a full half?
I was
Uh,
kind
uh,
of expecting about a quarter,
yeah, I was too.
and I think if you look at the stock market, it probably was as well. I think some of the gains that we had recently were already, the Fed, the market always looks forward, and I think they kind of thought maybe only was going to be a 25 basis point hit. It ended up being a
Yeah,
half, and the market kind of liked it. The few days after that as well. So yeah, I was kind of surprised. Now the big topic is it going to be a soft or it's going to be a hard landing on our economy? Um, you can read anything you want. Half of them are going to say it's going to be a hard, the other half's going to say it's going to be a soft.
yes,
But you know, uh, who really kind of knows?
yeah,
Here's the one thing I do see, Tony. I obviously we know it's kind of hard on the everyday person out there that's trying to make ends meet in order to pay bills and eat and do all those
yeah,
type of things.
yeah,
But the one thing that I will say is it seems if from what I see, people are out spending money.
yep,
Now, it might be end up being more the middle class and higher rather than the middle class and the lower, but people are spending money. I see that more and more, and just by even by dealing with clients, more people are traveling. They're doing a lot of things. They're spending a lot of items. So, so who kind of knows whether it's where we're going to land here in the economy? The next 6 to 8 months is probably going to be able to tell us that. Um, but by lowering interest rates, not only are they trying to have an impact on the economy, they're trying to also potentially boost employment.
yeah,
That's one thing that's actually a benefit of all this. The one thing that it's also in the news a lot. When you talk interest rates, you got to talk inflation, right?
yeah, yeah.
So
Inflation rates have finally come down a little bit, right?
yeah, and now here's the one thing I'll say, because I have a lot of these conversations with clients too, because when we have annual reviews, how's your income? How you be able to handle all this? And here's the one thing, Tony, when we had inflation around 7, 8, 9% there, prices are not going back. What
Right.
I mean by that is they're not going to lower cost. So the
Yeah,
big
when they
question
say
is
inflation is down, they don't mean prices have gone down. They just
no.
mean the rate at which prices are going up is slower.
That's exactly
Yeah,
right.
yeah,
So whatever they've gone up, they've gone up. They're not going back, but now they're going to be going up at a slower rate that I think everyone's going to be accustomed to going forward. So and hopefully by lowering the interest rates, and hopefully this is not going to be the last one here over the next year, 2 years. But the idea is by lowering interest rates, you're going to be able to hopefully stimulate some of the consumer spending on other type of things as well. Um, I'm sure they've looked at some data, and I'm sure some of the spend overall is down. So by doing that's the whole goal, is to be able to increase consumer spending. And let's face it, we're heading into the holiday season, and that's going to have a big impact on retailers going forward as well.
Oh, for sure. Yeah, that's true. We are headed into the holiday season, and is usually a pretty big impact. But if certain companies don't do the business they're projecting, then that can negatively affect the stock market. But usually it positively affects the economy overall, and we've hit record highs with the stock market this year. So I think overall things are looking good. I'm glad the Fed finally lowered interest rates. I mean, lowering interest rates have a positive and negative impact on people. There are pros and cons to higher and lower interest rates, right?
Well, yeah, there definitely are when you start getting into when we start talking about the benefits to the actual consumer, right?
Sure.
I think the biggest part that everyone looks at it is going to be what's it going to be able to cost in order to borrow money, right? So, and part of that could be credit card debt. By lowering interest rates there, it's going to lower your overall credit card debt percentage that you're paying. But here's the one part that I think that has probably another big impact, Tony. That's mortgages, right?
The real estate market.
Right.
Yeah.
So cheaper mortgages now actually means that you can actually borrow more,
Hmm.
right? So when you have an interest rate, that means you have a house payment. And if you can actually have a lower interest rate, that means you can afford a higher house payment, which means you can afford a higher or a dollar amount that's going to be higher for your house as well. So that can actually have a huge impact on certain people on what they can actually go out now and buy from a mortgage standpoint. Here's the one thing I will always say though, Tony, is just spend what you can spend. Just because you can buy more doesn't mean you need to be able to get a bigger house or a larger mortgage payment, even though now that you can afford it. Just spend within your means. Don't try to keep up with the Joneses when we start talking about, trying to buy houses or trying to buy things, right? Just because now credit cards are lower doesn't mean you go out and you get a higher debt. Debt's bad. And credit card debt's the worst thing that you can actually do because interest rates are still high, very high. And that's something that you just don't want to be able to do because you can't save. It has an impact on planning for retirement. There's just a lot of negative things that kind of go with having consumer debt.
Yeah. Yeah, there are. That's true. And, interest rates on debt, when interest rates are high, are tough, and they affect mortgages. Credit card rates are crazy, right?
They're super crazy right now.
30%. I mean, I thought there were I honestly thought there were laws like that's like loan sharking at some point. I mean, how much interest rate can a company charge people on a loan? I think there should be limits, but obviously there aren't.
Right.
30% is crazy if you're carrying any credit card debt. I don't care if it's $1,000, $500, $1,000. You're paying crazy money on top of whatever it is for whatever you're purchasing.
Yeah. I mean, that's going to have a big impact on what you can purchase. But the other part that I think that one of the things that allows you to do when we have lower interest rates, yes, you can get a higher, you can afford more house. But I kind of heard something interesting. I was having a conversation with someone in the banking industry, and they're already seeing an increase in already refinancing. So by even having lower interest rates, we think are, kind of high, whether it's going to be 5.5, maybe even 6% on mortgages. I do see people that has picked up when we start talking about refinancing already. So as interest rates come down, that's something to always be able to look at. We don't know how quickly they're going to come down, Tony, or how many times the Fed's going to lower the interest rate over the next year or two. But at any point in time, in order to save a little bit of money on what you're actually paying for your house or paying for, even a home equity line of credit, you're going to want to be able to look and see what interest rates you are paying. And it could make some sense in some cases to be able to refinance.
Yeah. Yeah, that's true. And, as rates go down, it gives you the opportunity to refinance. And I think that's what some people are counting on because all the conventional wisdom says that the Fed is going to keep lowering interest rates. I mean, nobody has a crystal ball, but they lowered it at 0.5%. And a lot of people were giving them putting pressure on the Fed because they thought they should have lowered it at least 4 times by now as the inflation numbers come down. So,
yeah, obviously the Fed, I think, took a little bit of a hit that maybe they waited too long for this.
Yeah.
I think everyone's glad to be able to see it.
Yeah.
It wouldn't surprise me, Tony, if we have another reduction by the end of the year. And then, heading into 2025. I mean, I would almost anticipate even, hopefully some lower rates going forward as well. But, by having, if now your dollar can go a little bit farther, right, that should be able to give you an opportunity to hopefully just be able to start saving for retirement as well. You want to be able, this is going to be able to encourage maybe investment as well. Now, when we start talking about investments, Tony, what's going to end up happening is as they lower interest rates, if you're in CDs or if you're actually in money markets or savings accounts, you're going to see a drop in those those percentages going forward. So the opportunity might be, it could be bonds, it could also be invested in the market. I'd highly recommend you schedule, a meeting with an advisor or give us a call to be able to see what opportunities are out there, because 4 years ago, Tony, it's hard to believe that's the last time the Fed actually lowered interest rates. It's been over 4 years.
That's crazy.
Yep. It's been a long time since they've lowered interest rates.
Yeah.
But if you go back prior to that, you weren't making anything in the bank.
No
CDs, right?
I mean, it was at one point we were near zero, right? I mean,
exactly right.
Basically.
So it's going to be interesting to see. The one thing I always say, if you kind of look at fuel prices, right? Fuel goes up quickly, sure doesn't go down quickly, right? And I think you're going to see the same thing with interest rates. It took a while for interest rates to go up, and I think they'll come down, a lot quicker than they actually go up. So that's one thing to be able to look at, especially if you're in CDs or right now. If you want to truly want to have a CD, this is probably the right time to be able to go in and get, a 2 or 3 year CD, because it's going to be the highest rates you're probably going to be able to see here, over the next year, 2 years.
Yeah, that's good. But all this, what you're talking about today, Cory, really leads me to really want to emphasize the point. You got to be working with a financial professional to deal with the changes, to make sure you're making the right moves. I wouldn't make any major financial decisions, without consulting someone like yourself, a fiduciary who's looking out for your client's best interests. And I know you can help our listeners out there with that as well.
Yeah. So, if you really think about it, Tony, why do people put money into CDs or high yield savings accounts? Normally it's because they don't want to lose money, right? Or they're afraid to be able to invest in the market. And the only thing that I'll, tell our listeners and viewers out there, there are so many products out there that might have a benefit to you. Whether it's life insurance that can build cash, or whether it's an annuity, or whether it's a bond, or maybe it's a buffer product like our structured notes that we're able to offer. There's so many different things from a diversification standpoint that can still provide some type of safety if that's what you want, but it still has the opportunity to be able to grow. And the goal is always to be able to outpace on what you can actually get in a savings or a CD.
Well, sure. And that is the goal. And I know that, when the interest rates went up there pretty high for a while, you could get some amazing deals like a MYGA, a multi-year guarantee annuity, where you could lock in for a certain amount of time. I mean, they get up to, I don't know, 7%, right?
6.5. I have
6.5
clients in 6.5.
6.5. Yeah. So it got up to 6.5% that you could lock in with, for 5 years with principal protection. Without so you're minimizing risk, but locking in a return of over 6%. That's unheard of. For a long time, because for a long time it was, super low. Like you'd be lucky to get 3, right?
Yeah. I mean, 2 or 3%, Tony.
Yeah.
Back
2.
in the day.
Yeah.
I mean, cash is king. And the question right now, I think you're going to see a lot of people scrambling on where they actually put that money, because interest rates will come down. It's going to have an impact on savings and CDs, and people out there are, what's some other options to be able to look at? I kind of talked about annuities. I talked about, life insurance or structured notes. This might be a good time to even look at, companies that are paying dividends as well.
Yep.
Obviously you're going to have market risk or exposure on the principle of it, But at least with dividends, you'll know you'll be getting a certain amount or a certain percentage of that coming back to you as well. So, there's a lot of different opportunities out there to be able to look at. Again, here's all I would tell you is, schedule a complimentary no obligation meeting. The worst thing that's going to happen is we don't do anything with you.
Yeah, you say, hey, you're fine, stay where you're at.
But you'll be educated enough to be able to say, you know what? Hey, there are some products out there. Maybe they're not for me, but just like anything else, I think everyone wants to be able to at least be educated, learn something to find out whether or not we can put you in a better situation, which is ultimately the goal, right? Yep. But so when we start talking about, when you start talking about investing, Tony, right? I mean, if you get safety, then you're going to get a lower guaranteed type of a return. Right. So the question is how much exposure do you truly want to be able to get the return that you want? Yeah. And I'm not sitting there saying that, in reality, no one should be 100% all safety either. Right.
Right.
Because let's face it, as interest rates go down, obviously you might not be able to keep up with inflation. I mean, that was a huge issue, prior to the Fed starting to raise rates. Was people couldn't keep up with inflation because banks weren't paying anything, whether it was a CD or savings.
Yeah.
So now you're in a position where you were still making 4 or 5% for a period of time, but you still weren't keeping up with inflation.
Yeah.
Right. So as the rates come back down, you have to maybe look at some different types of opportunities out there that's going to long term. I'm talking long term because, people are retiring 20 or 30 years now, Tony. Yeah. And you're going to have to be able to have a portion of your money be able to help you keep up with inflation, because we discuss it so many times on the show. Just because you need $50,000 today of income in retirement, that just only means that you might need 70 or 75,000, 10, 15 years from now because of inflation. It's a silent killer. I think everyone realizes how bad it really hurts you when prices do go up. And these were extreme circumstances over the last few years, but I think it shows everybody what the impact of inflation has on your overall retirement plan.
Yeah. Yeah, that's true. And you have to have growth to keep up with inflation is what you're saying. That's the bottom line. I hear you. That's what I hear you talking. That's the message I get from this. So you definitely want the right balance, and that's why you work with a financial services professional. But you've pointed out today, Cory, lower interest rates really do improve a lot of things. I mean, they encourage business investing. Like you said, it's good for businesses because of loans. It's going to help the real estate market. If it affects that, it takes a while for it to trickle down. When the Fed lowers an interest rate, it doesn't mean you're going to get necessarily an immediate 0.5% less on your mortgage interest, but it will go down, and especially if they keep lowering it. So I think it's good news overall, isn't it?
I think for the overall consumer, it's good news, and hopefully the Fed will keep triggering that and have that going. I think the more that lowers, the more spending we're going to be able to see, more people getting employed, and it's just a better situation overall for everybody here.
Sure.
So, for our listeners out there, just feel free to give us a call at 614-760-0670, or you can always visit us online at safeharboroh.com. If you have a financial plan already in place, there's nothing wrong with getting a second opinion just to make sure that you're set up the correct way. And if you don't have one, schedule a complimentary, no obligation meeting with us, and we'll put one in place for you. Again, anytime you meet with us, we don't charge anything. Every meeting is complimentary. We're very transparent when you do become a client, what fees you pay and things like that. But you don't have to worry about any of that when you're just coming in and meeting up with us the first time. Again, our phone number is 614-760-0670. And again, you can always visit us online at safeharboroh.com.
All right. Thanks, Cory. Great show today. Listeners and viewers, thanks for tuning in. That does it for today's episode of Financially Fit Radio.
Thank you for listening to Financially Fit Radio. Don't pay too much for taxes or retire without a sound income plan. For more information, contact Cory Sickles at Safe Harbor Retirement Group. Call 614-760-0670 or visit their website at financiallyfitoh.com.
All matters discussed during the show are for informational purposes only. Each individual situation may vary, and the opinions expressed here may not apply to everyone. Materials presented are believed to be from reliable sources, and no representations can be made as to its accuracy. All ideas and information should be discussed in detail with one of our qualified representatives prior to implementation. We are not affiliated with or endorsed by the Social Security Administration, the Federal Medicare Program, or any other government agency. Calling this number will direct you to a licensed sales agent.
All right. Hey, real quick.